Right, so we're here to talk trade today. I think it would be safe to say a couple of years ago you would bury the trade panel at the end of an event like this. But we've got Donald Trump to thank for making trade coverage great again. And we've got a great panel here to discuss it. So let's get straight into the conversation. But your views are also important here. And I believe you've had the app where you can be surveyed, explained to you. So we've got the first of those questions up, which we want to ask you for your involvement. Just how worried are you? Of course, as financial professionals of one ilk or another, we've all got lots of worries. But trade war itself, the economy is still going pretty well. China's still chugging along. Are we overblowing things here? Is it going to blow over, or are you really worried here? So let's get your views on that. And as you enter those, which we'll be very interested to see, we'll get the first thoughts on this from Randy. So Randy, we've been chatting a little bit earlier, and I believe you are somewhat worried here. Positions are hardening. How do you put the state of play between China and the US and the trade confrontation that we're seeing?
Thanks. I'm delighted to be here. I put it into a bigger context because I think it's not just about trade. There's a lot of discussion of trade, and obviously the president has been very vocal about trade, but he's also willing to conclude free trade agreements. And so renewal of what was the NAFTA with Canada and Mexico, renewal of a free trade agreement with South Korea. So it's not just that the president is anti-trade, it's a broader agenda, I think, with respect to China. It's really more fundamental. It's about the way the regime operates. It's not just about trade. It's about enforcement of intellectual property rights. It's about sort of a broader global geopolitical competition. And I think what that means is that there's really no end in sight, because I don't really see what China could do to be able to satisfy what the Trump administration concerns are that they have.
So there's no end in sight, I think, also gels with the BlackRock geopolitical risk dashboard. As investors make their asset allocation decisions, what should they be doing to take this longer-term confrontation into account?
Well, I think when you think about investing, it's important to start from not just from what am I worried about, but for also think about what's already in the price. And what our indicator suggests is that there is a great deal of worry already in the price about global trade tensions, and even more so about the US-China tensions. And guess what? Chinese equities, Asian equities, emerging market equities have become very cheap since the start of the year.
Today.
They're even cheaper today. They're cheap compared to their own history. They're cheap compared to developed equities. And so what this is telling me is, unless you expect things to get dramatically worse, there's a lot of value there, and maybe it's a good time to re-enter these markets. Now, you can't rule out that things get dramatically worse, but that's not our baseline, and certainly that's not our baseline as far as global trade goes. In fact, if you put aside the US for a while, every single country you can think of in the world remains interested in going into more trade deals. And if you look at the US relationship with its North American partners and with Europe, things seem to be calming down, settling down. So for us, this is a time to pause and think, okay, markets have factored in a lot of concerns. Maybe now is a good time to go back in.
And where particularly do you see some value?
So I would say, you know, obviously not all EMs are created equal, but they've all repriced. Right now, we would tend to prefer those EM most exposed to global growth. We like Asia, and we also like Asia because there's less political risk there than in some of the parts of this EM compound.
Right. Now, Santi, of course, it's an axiom of economics that no one wins a trade war, but in your new role, you're trying to create some winners. Can you tell us a little bit about that?
Yes, definitely. I think from taking a more Southeast Asia perspective, I think what we learned from these trade tensions is that there's perhaps two important lessons. Number one is that we need to find a new source of growth, a new engines of growth for these small emerging markets. And that could come from perhaps domestic demand and more regional trade. And the second is very important as well, is that new source of growth should be inclusive. It should address the issue of inequality, remembering that part of these trade tensions really coming from partly coming from the issue of inequality as well. And I think that's where it's interesting, given my sort of new position in a tech company, because that's where technology like e-commerce could come in and meet both objectives. Because e-commerce today is not just about disrupting the malls anymore. In this part of the world where offline retail infrastructure is still quite limited and still growing, there's a lot of room to, another D word I would like to use is discovery, where you discover new demand. For SMEs, for micro enterprises, you discover new markets you never know exist for your products. For consumers, you're buying products that you never know that existed in the past before the online world. You're putting it two together, you have a new demand being created, and it can be very powerful tools. One very inspiring example I always like to use, and actually she's a seller from this very island of Bali. She's an eyelash seller, and a few years back, she was struggling because the rent here is not cheap. And she needs huge sales force to go from salons to sell the eyelashes. At best, she could sell like about 100 pairs a month, which is already quite impressive. After a year and a half into one of our e-commerce platform, Shopee, she now selling over 10,000 pairs a month, 100-fold increase in 1.5 years. And she went from just herself and husband to now having 50 employees. So that's, we see a lot of that, and that's not just one unique story, but there's so many stories like this. In fact, about 2/3 of our sellers in our community are women. And a lot of our sales are happening outside the greater Jakarta area. So that's where you have a sort of more inclusive and a very dynamic growth engine as well using technology.
So Mark, if you can pull up the results there, let's see what our audience thought of that question and just how worried they were. And there we go. More than half think it's going to kill growth. And still, we've got a pretty good minority there that think it's all going to blow over. So we're pretty much at the extremes there. Randy, coming back to one of the things you said is, we can't really distinguish this trade confrontation from bigger questions.
Yes.
And one is, the biggest maybe of all, are we seeing a shift away from globalization and the sort of liberal economic environment that we've known for the past generation? Is that the sort of direction you anticipate we're now in for?
I'm not so sure about that, because as I had said, although President Trump obviously has been very vocal about trade, he's been willing to conclude trade agreements. So that's really very much part of the traditional globalization approach that Washington has taken for many years. Now, the rhetoric is certainly very different, but it's an effective renewal with some variation on the NAFTA agreement, the Korea agreement, and their discussions with other countries. So I don't think it's the end of globalization, but I think it's different because China is so much bigger today than it was. It's so much more important. And it has a very different character than, let's say, Japan from 30 years ago. Because if we go back 30 years, Japan was the China of its day, world's second largest economy, growing very rapidly. People very concerned about about Japanese competition on cars, etc. But Japan doesn't have the scale that China has. And it's very, very different, particularly interacting with technology, because innovation now is much less about the traditional making a better physical object and much more about technology, where when you have scale, like 1.4 billion consumers, that you can generate data and analyze the data on, that allows you to develop in a way that may not need the world quite as much as traditionally was the case when you're exporting cars and fruit and other things like that.
Right. Isabelle, how do you view from this sort of multi-year perspective? Is it where value questions, we're not sure yet because we don't know what the markets are going to be priced at, but as an investor looking with that longer horizon, how are you positioning and viewing your portfolio or advising people to view their portfolios?
Well, so from a slightly longer term horizon, right now we're seeing steady growth in the global economy. We think longer term, I mean, again, I sound like a broken record, but the longer term horizon you have, the more you have to think emerging markets are underrepresented in investors' portfolios. And if you believe that globalization isn't coming to an end, and I agree completely with Randy on this, then the more they're going to become integrated in the global economy, the more opportunities you're going to find. Now, are there going to be bumps in the road? Undoubtedly. But when I look at all the major corporates that are in the S&P 500 or others, these are global companies, and these are companies that are going to adapt to whatever trade regime ends up being in place. So, again, the longer term horizon you have, the least worry I think you should be. But in the meantime, yes, there could be some political shocks that markets need to adjust to, and with adjustment shocks. But near term, again, we're lucky that this is all happening against the background of very strong growth in the US, very strong growth in the global economy, and we've been hearing from the IMF in recent days, steady growth at above trend levels. So in a way, that can cushion the impact of that uncertainty that the trade disputes are creating.
If we do see supply chains change to adjust to the new situation of an ongoing trade confrontation between China and the US, are there any winners you can point to? Some Southeast Asian nations are sometimes thrown up as beneficiaries.
I think it's a bit too soon to be sure. Clearly, there will be winners, but rearranging a whole supply chain is costly. And our impression from what we're hearing corporates say is right now they're not rushing to conclusion in terms of, oh, let's pack up our factories in China and relocate somewhere else. There's still a sense of, let's see where this goes, and then we'll take a decision. But it's not illogical to think that other countries in the region would likely benefit if corporates came to the decision to relocate their production facilities.
Sure.
We were recently just in Thailand, and Thailand, as that Bloomberg index showed, was one of the strongest economies, or at least strongest on their index, because I think they've had very good policy, and I think they're very well positioned to be able to do well when some of these other shocks come along. If you have a view on that.
Yeah, I do think that Thailand, and actually, I think Southeast Asia economies, actually many of them, Vietnam included, is quite well positioned to even potentially benefit from a shift in supply chain. But another thing that I would like to put out there is the idea that maybe the nature of trade in the region will also change altogether. We talk a lot about supply chain, and of course that's very important drivers of trade growth, especially in this region. It's actually quite surprising if you look at trade between ASEAN countries. You would thought, well, it's growing very fast, it's a very big part of the trade, but actually a lot of that is business to business. It's driven by autos, electronics. Actually, we don't buy from each other a lot of the consumer goods. And so you always wonder, with growing tourism, we visited each other's country more, between Thailand, Indonesia, Vietnam, all these countries, can there be more direct trade between sort of consumer goods? And it linked back to the sort of e-commerce perspective. Once you identify all these, famous boutique, crafts, all things from each other country, get to know more, and now you have e-commerce platform to leverage on. Can you use that to increase the consumer goods trade within the region more? And that would be a different dimension of trade. It may not be as big in dollar terms as the supply chain, but it could be more inclusive because the benefits go directly per dollar to the local sellers, to the SMEs.
Right. China's, of course, the big player here. And it does seem, recent indicators seem to suggest there's some weakness creeping in parts of the economy. And of course, Donald Trump will use that as leverage. I just want to get the second of the survey questions up here, because we always come back to China on any sort of discussion like this. So if we can pull up that second survey and just get a view of people's angst over China. If China does start to slow meaningfully as a result of the trade confrontation and a loss of confidence that in markets, which we may have already seen, let's get your views on what you think of this. But as panelists, Isabelle, if you'd maybe want to start, where do you see that China's economy can withstand the trade pressures and maintain 6 and a bit more growth rates through the next couple of years, or are you worried that there might be a jolt a little below that?
So up to a point, I think yes, but the question is how. And what we saw in the first half of the year, so before the trade pressures from the US really became acute, the Chinese economy was slowing down, largely I would say as a result of the policy tightening that they'd been implemented. Now they've gone into reverse to counteract the impact of the trade shock. And so that credit deleveraging that had been taking place, that was very healthy, that was frankly necessary, is now somewhat put on hold. And we're seeing more fiscal stimulus being put through the pipes. That's okay for 6 months, that may be okay for a year, but you can't keep going like that for 5 years or more without having a growth accident and potentially a significant one. So I would say, short term, yes. Now, the other thing that most countries perhaps would do in the circumstance is let their currency depreciate. The Chinese authorities have been resisting that because they understand that it would be politically even more explosive to do so, and economically. But again, at some point they may consider the trade-offs that they have and decide that actually why not let the currency go. And so then there would be a global cost to this trade war that the US hopefully will consider. So for a little while, we can keep going like this. Beyond 2 years, I would become much more concerned.
So for a little while, you can still be in there buying value, but beyond that, we maybe get a little worried.
If there is no resolution or at least pause or stabilization of the tension with the US, of the trade tension with the US, yes.
For commodities, is a trade war good or is a trade war bad?
Well, nobody's going to put, tariffs on commodities, right? Because if you need to import commodities...
I've seen the argument that China will stimulate their domestic economy in the event of an all-out trade war, and therefore commodities are a buy right now. Is that something that you...
No, but look, what matters for commodities is global growth. A big part of that is Chinese growth. China's economy is not accelerating. It's just, again, trying to keep steady. So net, that's okay for commodities. I don't think that whether China's growing because of policy stimulus or because of good global trade environment matters, as long as its growth is steady.
And Santi, on your previous hat as a macroeconomist, the yuan anchor has been so crucial for this part of the world. If, as Isabelle suggests, we do see the yuan go through 7 and beyond, does that become the next big risk for EM?
Well, hard to answer that in my new role, but I mean, yes, in general, I think what we have seen trends on the past is that currencies in this region take greater cues from what's happening with the yuan, and with good reasons, because the economic ties on the trade side become stronger over time, and hence the dependence on that become more increase over time. So yes, if there are any movements in the yuan, I think that would have impact on the regional currencies for sure.
So maybe we can get the results up of our survey here to see how worried people are about China right now. And again, a bit of concern out there. It looks like people are betting that this is going to dent. We've also got a chart from Bloomberg Economics, if you can pull that one up, Mark, that showed a bit of scenario analysis on the dents to growth that are possible with various tariff levels. And this level of concern the audience has is probably well shared by the estimates in the Bloomberg Economics scenario analysis. So we've got the countdown clock running here, and Randy may have thought he's dodged a bullet here, but of course, as a former Fed guy, we've got to ask about our comments overnight from the president that the Fed's gone crazy. Has the Fed gone crazy?
I don't think so. But there are different points of view, even within the Fed, of whether the Fed should be on the path that it's on. There have been some of the members of the Federal Open Market Committee have said, well, maybe we should stop raising rates because the economy is not as robust as we think it is, and they would take, they would say a little bit of "I told you so" from what's happened in the markets in the last day. Others say we need to continue on this gradual path, And some say we're a bit behind the curve because with the unemployment rate below 4%, with the economy growing at more than 4%, we're in a time where inflation is likely to pop up. So there's a robust debate that's going on of whether they're doing the right thing or the wrong thing. The president has made it very, very clear that this is his opinion, that he likes low interest rates. I mean, he said this a year and a half ago when he was interviewing Janet Yellen as a possible candidate to be reappointed as Fed chair. He said, Janet Yellen's a low interest rate person. I like low interest rates. I'm a property guy. That's what I'm about. So he's just really repeated that. But what he's also said, which is very important, is that this is my view, but I'm going to let them do what they think is best. I have confidence in Jay Powell. I have confidence in the other people who have appointed to the Fed. If you look at the people who he has appointed, I think they've all been very sensible, solid people. What's interesting is that probably the person on the Fed board who might most agree with him is the person who is an Obama appointee, Lael Brainerd. So it's sort of ironic that his view is perhaps most correlated with the view of the person who was there from before rather than one of his appointees. So I don't think it's the end of the world. A lot of people say it's the end of the world. I really don't think it's the end of the world.
Are we at a stage now where the Fed needs to take into account China's slowing and the risks to the outlook from the trade war? Or is that something that Jay Powell can keep ignoring for now and just stay on the domestic economy?
Well, as all central banks, they're created by their domestic governments, and they're given their primary focus is on the domestic economy. So it can't be that the main focus of the Fed or any central bank is on other economies. It's got to be primarily about the U.S. The U.S. obviously takes into account what its policies impact on the rest of the world, because that then has an impact on the U.S. So it's a bit more indirect, but it still takes that into account. But it can't be the primary thing that they do. But the Fed, of course, does have an outsized impact on the rest of the world. In extreme circumstances, like at the World Bank IMF meetings in the fall of 2008, there's a lot of coordination among central banks and others. And then subsequently, there were coordinated rate cuts. So in extremis, there will be coordination. But until we get to that point, the Fed will, by its legal mandate, will have to focus primarily on the U.S. And as we were discussing before, and also when we looked at that vulnerability index, countries like Thailand have not been hit at all. The Thai baht has been strong. The economy is doing reasonably because they've had solid domestic policy. Other countries that have not had that kind of solid policy, countries like Turkey and Argentina, have been much more vulnerable.
Okay, well, we'll finish there. We strayed a little from trade from time to time, but you can't unpick one from the other. So thank you very much.